Hello, everybody. Dan Tapiero, founder DTAP Capital and a co-founder of Gold Bullion International. And today I have the pleasure of interviewing John Hathaway. John, good to see you.
Good to see you, Dan.
John is a legend in the gold space for you who are not aware or who don't know of him. I would say certainly one of the 2 or 3 most successful and as I said, certainly well-known gold equity fund managers. And he's been with Tocqueville for a very long time.
22 years.
22 years. Currently the chairman of Tocqueville Management. And he's just done a deal recently with Sprott Gold of Canada. And so I thought we'd just start off talking a little bit about what he's doing now and what this deal means. I think it'd be interesting for the viewers to hear.
Great.
Yeah.
So we're very excited to be joining Sprott. Sprott is, I think, becoming the go-to name in the precious metal space. They are 100% about promoting what we do. They have closed-end bullion funds. They have lending to the junior mining space. They have some ETFs that are basically Canadian-based. And so by joining them, we now have access to their due diligence capabilities, particularly in the smaller cap space. Mm-hmm. They have numerous relationships throughout the business, which is helpful to us. And last but not least, they have a full-time marketing group that I hope will be very successful in raising a lot of money for what we do. Oh. And I think the timing is terrific because I think gold has finally turned the corner and hopefully we have the wind at our back instead of in our face as we've had for the last 6 years. So I'm very excited, as is the rest of the team. We'll be continuing to do what we've always done, which is basically very granular due diligence on specific companies, active management, for our mutual fund and our European funds that we sub-advise.
Yeah, that's very exciting. I think it's a fantastic platform. Why don't we just get right into it and start with your view on, and I think you're right that, after 6 years of slog, gold has broken out of $100 range and is now at a 6-year high, touched 1550. But let's talk a little bit about your view of the macro backdrop, because I know that plays into your overall view on gold.
For sure. I think the bell ring, and when gold broke out of this 6-year base, you can trace it back to the change in the mindset of the market, whereas going into the end of last year, the expectation was that the Fed would continue to be on a path towards tightening, running off their balance sheet, and basically less and less accommodative in terms of providing liquidity. And then when Powell had that press conference in late January and said, and after the market had basically completely fallen apart in December, said, maybe we won't be running off the balance sheet. Maybe we'll just stand pat. Mm. That was kind of a hint that they were going to change course, which of course they have done and are probably going to go even further. And you can sort of identify the breakout to that. And then also, I think he said similar things in June. But clearly, I think the expectation of tightening is the pretense that they were going to be a responsible central bank is just totally out the window. And they're joining the crowd and creating more and more liquidity. We saw what they recently did in terms of the repo market. They're not calling it QE, but I don't know how they get away with that. Yeah, $60 billion a month is bigger than QE2, I think. So I think we're back on a path towards monetary debasement. Okay. And that is what we in the gold world have always expected would take place, and now it's sort of out there for everyone else to see. That's one thing.
What are some of the other things that make you think that the gold price has more legs here? Yeah.
Well, another thing that I think about a lot is you have something like 15 to 17 trillion, nobody really knows how much, of sovereign debt that has a negative yield. And to me, that is an evidence of systemic risk that's huge, way bigger, in my opinion, than the housing market or the mortgage market, toxic mortgages of '07, '08. When interest rates go up, and they will go up in my lifetime and yours, there's going to be a huge amount of capital lost. It'll be held by pension funds. It'll be held by institutions that are, from a regulatory point of view, have to have so-called safe assets. Obviously, I suppose central banks have it as well. But there will be capital losses that will dwarf what we saw in '08. And I'm not sure how the repercussions of that, but I think they will be negative for financial assets in general.
But, you know, gold has been very tied to the real rate. So if you think rates really are going up a lot, that's not necessarily positive for gold.
If the real rate goes up, I would agree with that, because higher real rates are poison for gold. But if you go back to the 1970s, we had nominal rates on the short end near 20%, and 30 years were 13 or so. But the real rate was basically neutral to negative, and that's because of inflation. So another thing that nobody expects, and why gold is a cheap, very cheap option with asymmetric returns on the return of inflation, which is the only way governments will be able to deal with the unfunded liabilities in pension funds and entitlements, will be to devalue through inflation. And you know, just how that comes into play, we don't know.
Right.
But to me, if rates were to go to 1 or 2%, two things are going to happen. One is a highly valued financial assets, bonds and equities, are going to take it on the chin. And two, that's most likely to happen under conditions of inflation.
But is that your base case? I mean, we've talked quite a bit about this. Is that your base case, that we at some point in the next few years have that return of inflation?
I wouldn't say that everything rests on that,
Yeah.
but why not take a free option on the possibility, which is where we sort of have to go. Yeah, I don't know if we're going to have the kind of inflation we saw in the '70s, but I think we'll probably have more inflation than we have now. But again, I would not rest everything on that particular point.
Right. I mean, that's very strongly linked to a view of the dollar. You're probably not thinking that we have inflation rates backing up and the dollar continues to be strong. I mean,
no, just the opposite. I would
Right,
say
exactly,
I would
yeah.
say the dollar, you know, and how do you measure it? I mean, the DXY is basically a pair trade with the euro. Could the euro go up against the dollar? I mean, I think it can. I can think of reasons why it would, but that's not really fundamental, because I think, you know, when I hear this thing, you know, in the financial media that the dollar is the best house in a bad neighborhood, I think to myself, this is ridiculous, because the neighborhood's going down the tubes. And so maybe the dollar is the tallest midget, all these stupid analogies. But at some point, capital will seek out safety, which is what gold represents. And, you know, I have to point out that gold has outperformed every stock market since 2000. I mean, most people don't even think about that.
and that's been in a relatively benign, I mean, over a 20-year period, we've had ups and downs.
Right.
So, I mean, I think that's almost separate from what your view or my view or anyone's view is. It just is a fact that
It's a fact
in the
that
last 19 years, right,
Gold has
since
outperformed
2000.
bonds
Yeah.
and stocks.
Yeah.
Not only the S&P, but if and gold is at record highs in yen, I think, Canadian dollars, the pound, the euro, and Aussie dollars.
Yeah.
And it's just the U.S. dollar where we're still sort of struggling, and it's because the dollar has been relatively strong compared to other currencies.
Yeah, I want to get back to sort of talking more about some other things that you think are impacting the price. And we had talked a little bit about the geopolitics. What's your sense there? What are the drivers there for you?
You know, there's so much to talk about there.
Yeah.
I mean, you and I talked before this about what's going on in Turkey. And what's happening there is a disaster, and it's basically alienating centrist type Republicans who voted for Trump, holding their nose maybe last election, and you just wonder if he's going to keep them. And the point of all that, and going from Turkey to Trump and the election cycle, is the chances that you would get a more radical, very liberal, populist, left-leaning administration is downright scary in terms of what it could mean for future budget deficits, for tax rates. And if you're, for example, allocating capital for a major corporation and you're thinking about making major investments somewhere in the world, in the US or elsewhere, and you don't know what the tax rate's going to be, you're not going to do a darn thing until the election is over. So I think there's a very good chance we could be in recession territory next year, which would do a couple of things. One thing would be the budget deficit, which just crossed $1 trillion this year in a time of economic expansion, could easily go to $1.5 trillion or more, $2 trillion. I mean, it's going to be way higher than anyone thinks. So that won't do wonders for the credit rating of the US dollar, and that's how you could get a much weaker dollar, which gets back to investors, capital looking for a diversifier, a non-correlated asset that could protect capital under those circumstances, what I would imagine to be adverse capital markets.
I mean, it looks to me like Trump has this thing already in the bag, but it sounds like you think that Warren has a decent shot here.
I don't know. I mean, I just don't know. I mean, but I think
Yeah.
that he is beginning to lose the center that held together for him in 16. Mm-hmm. And it may mean that just some of those people will not come out to vote. I don't really know. If it's scary enough on the left, maybe he still gets in. But I do think it's more in question today than it might have been 3 or 4 months ago.
Mm-hmm. And what about the China-U.S.?
The China deal.
Yeah, or no deal, or who knows exactly.
And that's a joke to me.
Yeah.
Because when gold got pounded a couple of weeks ago, because we were going to have this fantastic, once-in-a-lifetime, tying all the loose ends together deal, that's when gold got smacked. Mm-hmm. And the thinking was, I'm sure, in terms of the sort of reflex action was, well, all our problems, all the sort of volatility we've had over the summer in the equity market, the uncertainty about the economy, was all because of tariffs and because of no deal and Trump playing tough. And so what we have is a show of American weakness and the Chinese playing Trump like a fiddle. Because, Trump said it's the best deal ever. The Chinese are saying, well, maybe, but we still have to talk. They're talking about staging it. Everything I read about it makes me think that we're not sure if there's a deal. And being in an election year, I think the Chinese have the strongest hand, and that's going to come out in many different ways. So I don't think that the so-called Chinese deal, whatever it is, we don't really know, is the cure-all for what was taking place, causing market volatility and downside risk.
Okay, so you've put together a few of the macro points that I think are driving your view. So what's the forecast on the gold price in your head? Let's say 18 months, and then let's go 5 years out.
The way I've heard it put best, and I've learned after all these years never to put a number and a date in the same sentence in terms of any kind of price.
That's okay. What do you got?
I know we're among friends.
What do you got? Right.
So the way I like to, I thought it was very well put by David Rosenberg of Gluskin Sheff.
Okay.
And David gave an interview with the National Post in Canada. And then he and I sat on the same stage at Beaver Creek, and we talked about it further. And what he said, and I think this makes a lot of sense, is that we have a cycle high in bonds in terms of valuation. We have a cycle high in stocks in terms of valuation. And the one major asset class that's been left behind is gold. And the interviewer said, would you be surprised by $3,000 gold? Now, this is a guy who's not a gold guy.
Yeah.
He's a rational economist, made his career. You're shaking your head.
Somewhat rational. I mean, I've read his stuff over the years.
Yeah, okay, but anyway, he's a well-respected guy.
Yeah,
He's not in the gold camp.
Right.
But he said he would not be surprised by $3,000 gold.
Yeah.
And I think his point was that gold needs to make a cycle high, and pick any number. I mean,
So let's talk about that for a second. So why do you think it hasn't? Why have people been hesitant? I mean, it just broke out a few months ago,
Right.
and it was dead to the world for years, 6
Right.
years. So what's kept them back from buying? And then what's going to get them to allocate?
great question, and that's what I think about all the time. So I think the fact that mainstream investing, S&P names, tech,
Yeah.
stocks, all that has done fine. So why would you venture into something that hasn't performed? And frankly, it's the third rail of investment ideas, because I know I've heard of your partner getting tossed out of an office because he was going to talk about gold. He said, "Don't you dare talk about gold to my team," some RIA in Wisconsin or someplace like that.
Right.
So why is it the third rail? Because it hasn't performed for 6 years.
Though it's the number one performer from 2000. People
But
ignore that.
memories are short.
Right, of course.
And we understand that.
Right.
But the other thing is that even when I talk to somebody who could allocate to gold, they may do it personally, but they will not do it for their clients because there's career risk. If you underperform,
The stock.
if you're a mainstream investor and you're 20 basis points, let's say, behind the S&P, and you had a 5% allocation to GLD or GDX or
Yeah.
the kind of thing we do, you could get canned. You certainly would find tremendous disapproval.
Okay, well, doesn't that mentality have to change?
Well, there was a time,
To have-
and
to
I
have a
remember
remove,
it, when gold was really doing well, and everybody wanted in at the top.
Yeah.
So
You mean 10, 11, or do you
yeah,
mean
11, yeah.
78? So, okay.
Well,
Yeah,
no,
yeah.
I'm old enough,
Yeah,
but I wasn't doing gold then.
Yeah.
But that just shows you how cycles work and how psychology changes. So we are kind of just coming out of like a 6-year nuclear winter, and it's hesitation, early stage stuff. Just an interesting little fact is that even though the gold-backed ETFs have gained AUMs this year, GDX has lost like $1.6 billion, even though it's up 35%.
GDX is the gold miner ETF.
The gold miner, Van Eck
We'll
gold-
get into that in a
second.
In a minute.
Yeah.
Yeah, we'll get into that in a minute. Okay, so again, you say nuclear winter, and I'm still trying to figure out. So what gets people to have a different mentality? And the way you responded to that was really to refer to sort of the U.S. institutional investor. But we know, 70% of global demand for gold is China, India, and the emerging markets.
Right.
And so maybe it's the U.S. institutional investor is not changing their view until it's at 2,500 or 2,800.
Probably.
So isn't the next leg here going to be driven by, I mean, we've seen huge Russian central bank buying. We know the Chinese are buying. Do you have any sense as to what might drive them to, take us to the next level?
You're talking about the U.S. RIA?
No, I'm talking about the foreign demand. What they've been steady, but is there something because I don't know that the IRAs, without something more obvious like, okay, MMT is coming in, something really
Things
obvious
like that.
I don't know that they'll switch, and this concept of career risk, I don't really understand that, but I know it exists. I just wonder, is there something on globally that you think could get the global buyers? Because we're here in America, and America is still the wealthiest country in the world, but we're not a driver for gold.
Not now.
Not now.
We will be.
Okay, so you think we will be?
I think the marginal buyer
That's interesting. Yeah.
are investment flows in Western capital markets, Europe, U.S., and so forth.
So why haven't the Europeans, with all those negative bonds, all their bonds are yielding negative? You would have thought that, they would have taken gold up to 2,000, 2,500.
I think there is, I know in Germany, where we sub-advise UCITS, there has been physical buying and substantial. I don't have the number off the top of my head, but there has been substantial buying, particularly in Germany. But I don't think, and I probably would disagree, people would disagree with me on this point, I do not think that physical buying of metal has been steady and particularly by central banks rising. I don't think that drives the gold price as much as people might think. And we can talk about supply and demand in a second. Mm-hmm. I think that it's the movement of capital into gold surrogates, which would be futures, COMEX futures, derivatives, and all options, and all that sort of thing.
The leveraged money.
The leverage money. That really is more of a market-moving explanation than the steady sort of absorption of physical metal in the 70% of the world we just talked about. Because that's almost always there. And what happens actually, now the gold price has moved up this year, the Indians have backed away. They'll come back, but they'll wait for a while and see if the price sort of settles in, because it's kind of in the DNA of most Asians to have physical metal. And it's almost always there. Central banks are taking up a huge amount of gold, but I think the swing factor comes down to the leveraged players that buy.
So you mean Paul Tudor Jones sticking up his hand and saying, it's my favorite bet over the next 2 years, and I see 1,700. That's going to get.
He
did. He said that.
I know he said it.
Yeah.
Yeah, you've got a lot of these really elite luminaries like Ray Dalio and Rick Reeder, the bond guy at BlackRock. I mean, they're all saying the right things. Mm-hmm. And you kind of wonder, say, well, why aren't people doing anything about it? And I think it comes back to what I said earlier, is that it's just been in so much of a penalty box for so many years, and the career risk that goes with it. That'll change, but that's kind of what.
But that's good. It's got to climb a wall of worry, and if everyone were, jumping up and down about it, it's done already. I mean,
exactly.
Right. So.
Right.
Okay. So let's move a little bit now to the supply-demand picture, which you know a ton about.
Yeah, no, I mean, you can get the numbers from the Gold Council. I mean, they're pretty much the Bible when it comes to that. You kind of have to look at it. The picture is really, you have supply, which is new mine supply, is sort of flattening out. And it probably is on a glide path lower. I would say
that's interesting.
It's a glide path lower, maybe for 5, 6, 7 years. I don't know.
Really?
And that's because of how hard it is to build a new mine today. And these big miners, little miners, big miners, collectively have a reserve life that's the lowest it's been in 30 years. And I think on average, it might be 10 years, 11, something like that.
Yeah, all the gold critics always say, you can always dig more out of the ground. But
yeah, you can if you can get permits, if you can go to, a lot of the gold is located in
Turkey, you mentioned.
Turkey, which is one of the better ones.
Right.
Try Burkina Faso, try, places, Argentina. Rule of law is very changeable.
Right.
So, is capital going to go into a place like that? Well, in some cases, yes, but mostly no. And so you've got that at work. You've also got ESG is a huge thing now. And so environmental,
so where it's coming from. So like
where it's coming from
right.
and permitting,
So maybe just explain that a second. I mean, that's the ESG. Yeah.
it's just getting permits.
Yeah.
The mining industry has a bad rap of having, raped the landscape.
Yeah.
And that was probably deserved maybe 50 years ago. But you cannot build a mine today, anywhere, I don't care what country, without complying with first world standards on emissions, dealing with toxic things like
Runoff.
cyanide, which is used. So, and getting the permitting is excruciating, and getting more so all the time. So what used to take maybe 5 years now takes 10 years. 10 years, maybe longer. There's a mine that's probably could be a great mine in Romania that everybody's known about for, God, I've known about it since I've been doing it for 20 years.
I even know about it.
Yeah, and it's not getting built because the environmental movement, the green, not to be pejorative, but they have successfully blocked it.
Yeah.
So when I say a glide path down for 5 years, it could be longer, just because the hurdle is so high.
So it would take a significantly higher gold price to really tease that gold out.
Exactly.
Right.
And I don't know what number that is, but it isn't another $200 or $300. It's probably 5 years of steady prices in closer to 2,000.
Yeah. Yeah, that's interesting, and I think that's important to think about it within that framework, because it sort of puts a base underneath the price. So if it's 1,500, if you're concerned, it might go back to 1,100, 1,200. If we're on a glide path lower in supply, that it's going to be very difficult for it to stay down if it goes back down for whatever reason.
Let's pretend it goes to 1,300.
Right.
It's going to scare the devil out of investors. It's going to scare the mining companies. They'll just go into a bigger shell, hide further under their desks, whatever. So the mining companies, the big ones like Newmont and maybe Barrick, for example, are still using $1,200 gold to value their reserves. And if they're using it to value their reserves, that's how they value a potential new mine. And the numbers don't work at 1,200, period.
It's almost more bullish long term if we do go back down.
Well,
right?
I wouldn't,
in a way.
I wouldn't enjoy it.
I don't want it either. Trust me, I don't.
Yeah.
But the way the way.
Yeah, no, that it would just cure the. It would just give you another 5 years of no new significant supply.
So you said something recently. We were chatting that you were at a conference or a meetup. Your team met over 60 companies.
Right.
So could you? I mean, I don't think many of these viewers get to talk to even one company.
They wouldn't want to.
Well, well, anyway, you've got a whole team and you're very engaged. So maybe some of your observations from those conversations would be interesting for people to hear.
There are a couple of mining conferences every year that I go to. They're very helpful for me and the rest of the team. One is the Denver Gold Show, which takes place in September every year. Another one is the Precious Metals Summit, which takes place in Beaver Creek every year, very close to
where you live.
To where I live.
So it's very easy.
It's convenient, but it also is good because it has all the smaller companies. And then BMO has one in Florida, Hollywood, Florida, near Miami, every February. So that's how I stay in touch. Now the team basically they're in touch all the time. But I get to see, in the space of those 4 or 5 days, 60 different CEOs.
So what were some of the, your observations that really stuck out, that you found really interesting?
Essentially, they don't believe the gold price.
Oh.
They're not excited about it.
Okay.
They're, I think, conditioned by years of having been beaten down by investors, by low stock prices, to be ultra conservative. And there's just not a lot in the pipeline of new mines as a result. They've cut back on exploration. When you see Barrick and Randgold getting together, I think there's a lot of vacant office space in Toronto as a result of that. And when Goldcorp and Newmont got together, there's a lot of vacant office space in Vancouver, where Goldcorp used to be headquartered. And so the intellectual capital of the business and the lifeblood of new mine development is your geological staff. And if you cut back on that the way it's been cut back on, basically truncated completely, you don't see it in the numbers so much, but certainly there might be fewer projects that are looked at, fewer projects that are advanced, and so that would be one observation. But I think basically they look at, as most people do in the investment world, and it happens in business too, they look at life with a rearview mirror. And they look at the past 5 or 6 years, and they're super reluctant to stick their neck out to spend $2, $3, $4 billion, which is what it takes to build a significant new mine.
But you're very bullish generally on the sector, and I think you mentioned before the GDX, which is the Van Eck ETF,
The Van Eck ETF.
on larger gold miners.
Right.
I mean, I looked at the chart recently, and it's at the same price basically that it was in 2008, which is totally crazy given what looks like to be a pretty good future. So,
Right.
what's your sense just broadly about the sector? Why you think, can we go back up to those highs that we were at in 06, 07?
It has to be driven by the gold price.
Okay.
I mean, you look at the fundamentals, and every company has different aspects to it. There's, local political risk. There are so many different things in terms of vetting an asset and vetting a management. But at the end of the day, there's only one thing that really matters, and that's the gold price.
Well, it's also how they manage their businesses.
There's all of that.
Right,
you can't.
right.
You
But
have
it's
to
not
pay-
going to have a big move without.
Right. You're not
gold.
going to get. You're not going to get
Yeah.
generalist investors coming into the space
Yeah.
unless you have an eye-popping move in the gold price.
But these things are really super cheap. I mean, some of them trading at 4 or 5 times EBITDA.
They're ridiculous. Particularly the smaller ones.
Yeah.
And it's almost to the point where, and we figure this, that you can buy a new mine by buying an existing company at a 35% discount to what it would cost, let's pretend you're Newmont or Newcrest or one of them, to start from scratch.
So they're just
So
gonna
the
double
make or
that
buy. You can pay a premium in the market for a single asset company and have it be accretive to obviously the target and also to your own shareholders. And you're saving all that money on building a new mine. So I've never seen that in 20 years of doing this.
Really?
Never seen it. So
Wow, that is cheap.
to me, that just suggests that when the psychology changes somewhat, this is again in the corporate suites of the larger companies,
Yeah.
you will see some, not merger of equals, which was Barrick, Randgold, for example, but larger companies swallowing up smaller ones.
Yeah, that's exciting. So why don't we talk about some of those companies or your favorite? I think that later on we're going to actually talk a little bit about Bitcoin, if you can believe that or not, and crypto.
Happy
only
to.
only a little bit. John's probably the only person in the entire world who can speak about gold mining, equities, and Bitcoin at the same time. But the reason I mention that is that there are companies in this space that have the ability to go up 3, 4, 5, even 10 times. And those are sort of Bitcoin type numbers.
Right.
And so, I know you have some favorites, and maybe just tell us.
The thesis really was what we've just talked about, which is the inevitability of M&A. Mm-hmm. And the observation that there are companies that are that are generating free cash, trading at 4 and 5 times EBITDA. Having been a value investor back in the 70s, I remember that was pretty cheap. Mm-hmm. And you look around in the markets and say, well, what what else is there? And, come back to this space as being a standout in terms of valuation.
Yeah, especially given that the backdrop, both macro and what I would call macro gold,
Right.
are so positive.
Yeah,
I mean, there seems to be a complete disconnect.
And I think that's because
Yeah.
you've sort of gone to this passive investing where
Right.
capital, sort of hyperactive capital flows can go in and out of something like GDX. And when you look at the array of research that's done on the sell side, it's basically there to serve the investment bankers. So we have extreme value.
Yeah.
You have reason to think that earnings will rise substantially because of a view on the gold price. Not everybody would agree, but if you think that,
Yeah.
you can make a case, and then you have the possibility of M&A. You can make a case that you have a lot of 10 baggers in market caps of $1 billion.
So give us a few names.
Sure.
Like what are your that
Okay,
that you think
a
are-
handful of names. One would be Detour Gold.
Okay.
It's a low-grade but long-lived mine in Canada, where we've just gone through a very constructive replacement of the old board, installed a new board and new management at the highest level, where all the blocking and tackling that you need to do in a large open pit, low-grade mine needs to be done. But suddenly this company, and we're not all the way there yet, is starting to gush free cash. Even at these gold prices, call it 14.
And what's the market cap there?
It would be a couple billion Canadian, roughly. That's, and it's in my mind, it's a crown jewel, the kind of asset, because if the mine life of the industry is collectively, say, 10, 11 years, you want something in Canada that has a 20 plus year mine life. And that's just knowing what we know now. I mean, we haven't even talked about discovery around the existing mine works. So that would be one example that's liquid that you easily buy and maybe get out of if you change your mind. But that would be a top favorite, let's call it. And another one would be Torex, which has a mine in Mexico that is generating tons of free cash. I think it's trading at 4 to 5 times EBITDA. And I forget the multiple on free cash, but it's significant. And it's a single asset company, so there's a single asset company discount. And one thing I didn't mention is that when a Newmont would come along, all the headline worries about labor strife and so forth in that particular state of Mexico, which there has been, would go away because it's sort of taken up into the fact that, pretend it was Newmont, has 13 mines and people don't focus on local issues the way they do on a single asset company.
Oh, I see.
So that's part one. Part two is that they have a new technology which can take 30% out of mining costs. And I won't get into it, but it's been developed by them. And it basically has to do with mechanization. Some of it's off the shelf, some of it's proprietary, it's all patented. And what I think will happen with Torex is that they will be able to buy stripper type assets, stripper wells, but assets that have been given up for dead by the existing owners. But with their technology, they can bring them back to life and maybe get another 10 years out of them.
Wow.
And that single company discount, single asset discount, if they're successful in doing this, and I expect them to start actively doing this in the next 12 months, then it disappears. And suddenly Torex has mines all over the place that everybody thought were no good. And so anyway, that's another one.
Oh, that's interesting.
One more maybe. Mag Silver, which has a joint venture with Fresnillo in Mexico. It's called Juanicipio, which is neither here nor there, but very high grade. Will start producing in 2020, at the end of next year, and the cash generation will be because of the grade and without any sort of heroic assumptions on the silver price, will be very substantial. Fresnillo operates the mine. The ground has tremendous exploration potential. So in our minds, in our analysis, the initial production of 4,000 tons per day will double soon thereafter to 8,000. None of that's in the share price. There's nothing in the share price for a better silver price.
Yeah, which I see as sort of a leveraged gold.
It's
getting into the
gold on
specifics of
steroids.
it.
Yeah, it's gold on steroids.
Yeah, but so those are two in Mexico, and you did mention you're concerned about jurisdictional
Right.
issues. So I wonder, is there something in the U.S. or something else in North America that you like? I mean, for people who don't want to venture outside.
Sure. Yeah, they're again, the world is shrinking in terms of what your comfort level with specific jurisdictions. I mean, to me, Detour is the sort of the icon of that. But you could also mention something like Nova Gold. Our friend Tom Kaplan is very prominent in.
Yes.
But the mine is located in Alaska. It's owned jointly with Barrick. It will get built, and when it gets built, it will be the biggest gold mine in the world, the biggest, longest lived. It'll be a fantastic asset. They're biding their time. Barrick is biding its time. It's gonna happen because it just has to happen.
But does that contradict your comment earlier about supply sort of running off?
None of what I've talked about is big enough, even this mine,
right,
to change that.
Or big enough, quick enough.
Quick enough. It's episodic. It's just not. It's not like oil where you can suddenly punch a bunch of, or a new technology that would suddenly, make uneconomic ground become economic. So you just don't have that. So yeah, Nova Gold would be, again, safe jurisdiction, and fabulous asset, smart people,
super
well
leveraged,
financed,
super leveraged.
and to me it's a perpetual call on the gold price.
Yeah. So that's very interesting. And I would say, I mean, these days, I don't really hear about gold miners from anybody.
That's because
not even in
nobody.
passing, which is, I know someone, I mentioned to somebody that I was interviewing you, and they're like, oh, John, great guy, like one of the few survivors of the last 6 years, but is now in a very good position. And so if you haven't had to be in the market or weren't in the market in the past 6 years, now, now's a wonderful time.
I'm excited. I mean, we've done a lot of work. We know a lot of all the assets and stuff that's still in development. So I think we have concentrated in our small group a lot of intellectual capital that's going to be very hard to replicate, at least for a few years.
Okay, well, let's make a slight little shift, a detour, to talk about Bitcoin a little bit, because I think there's a universe out there of which I'm a part that think that Bitcoin really is hard money. I don't like using the phrase digital gold because I think that Bitcoin is a lot more than that. I think it's as I've said, it's 20 things and maybe this is one of them. Coming from a traditional gold background, I think it's interesting that you've engaged with it. And so why don't we just tell the audience some of your thoughts and what you think of it? Because there are a lot of people in the gold world who are not friendly towards Bitcoin, and people, I would say, generally over the age of 50, 55, their immediate response is that it's magic, hooey-fooey money, and it's a fraud, or they talk about Mount Gox still, or whatever it is. And so I think it's fascinating that you don't see it that way.
Yeah, and again, I'm way less knowledgeable on this than on gold. But what I think it's important to know about, because some people think of it as money, used in a transactional form, maybe as a store of value. And, in my position, I need to know about at least something about it. My observation would be that money is never constant. It's always changing. It's evolving. I just think, back a few years ago, you would pay for things in cash. I mean, who uses cash now?
Yeah.
Credit cards are the only way to go. And, so why can't it go beyond that to digital transactions? I mean, it's so much more convenient. That has nothing to do with the merits of gold. I look at Bitcoin as being, it's related to gold. It's part of an evolution of what money is all about. And I don't think Bitcoin threatens gold, but I think it can be useful and used in a monetary sense. It can be an investment, a speculation, whatever you want to call it. I don't understand it beyond that, but I think people in the gold space need to know that it's not a threat. I mean, if anything, it's an ally, because I see it as having been invented, sponsored by people who did not trust the financial system as it stands, paper currency, central banks, all of that. So, I mean, anybody who's sort of that persuasion has to be thought of as in some way or another as an ally. And that's how I see it.
The biggest problem with this whole space is I say it's like a language problem, that every person you speak with, and this is no joke, articulates what Bitcoin is to them differently. So it's not like saying gold, yellow metal. We all agree on that.
Oh, but everybody has a different, yeah.
If I say Bitcoin, what does that mean? You're going to get something different from each person. So someone might say, a gold person might say, oh, Bitcoin, scarcity, right? Because Bitcoin is supposedly scarce. Someone might say digital money. Someone might say, programmable money. Someone might say, fraud. I mean, it's unbelievable.
Yeah, see,
so the way you articulate it,
to me, the last thing I would do is get in a pissing contest about Bitcoin.
Right.
As far as I'm concerned, if it works, that's great.
Yeah.
It's not a threat to gold, but it's kind of like,
and you said that,
a fellow traveler.
Thanks for that talk and update on your views. I think it was a fantastic interview.
Thanks.
Fantastic.